Good morning. This is an open meeting of the United States Securities and Exchange Commission on July 26, 2011. Today we will consider three items related to large trader reporting, asset-backed securities, and ratings references. We will begin with the new rule that would establish a large trader reporting regime to provide the Commission with better insight into critical segments of market activity. The large trader reporting rule has two primary components. First, it would require large traders to register with the Commission through a new form, Form 13H, and second, it would impose record-keeping, reporting, and limited monitoring obligations on certain registered broker-dealers through whom large traders execute their transactions. The Commission initially proposed the large trader rule in April 2010, and less than a month later, the importance of this proposal was highlighted when we experienced the flash crash of May 6th. That day dramatically demonstrated the need to enhance the Commission's ability to quickly and accurately analyze market events. The fact is, we live in a time when trades can be transacted in milliseconds or faster. Large market participants can trade electronically in substantial volumes at high speed and in multiple venues. It is a time of rapid developments in trading technology and strategies. It is for that reason that we launched a comprehensive review of U.S. market structure, a review we initiated some months before the flash crash. The large trader rule is one of several measures that grows out of that review, a rule that would enhance the Commission's ability to obtain information about the most active market participants. This new rule, 13H1, would significantly bolster our ability to oversee the U.S. securities markets by allowing the Commission to promptly and efficiently identify significant market participants on a cross-market basis, collect data on their trading activity, reconstruct market events, conduct investigations, and as appropriate, bring enforcement actions. The collection of this information is particularly important given the increasingly prominent role played by very active market participants, including high-frequency traders. In addition to this large trader rule, the Commission previously proposed establishing a consolidated audit trail for equities and options, a system that would capture customer and order event information for securities across all markets. I expect that a consolidated audit trail would take longer to implement than the rule we are considering today, but it would collect and consolidate much more extensive order and transaction information than that contemplated by the large trader rule. In particular, the large trader regime is more limited in terms of its scope and objectives. For instance, the technology requirements of this large trader regime should entail much less change than the proposed consolidated audit trail. Further, the large trader rule would leverage existing systems to address the Commission's compelling near-term need for access to more information about large traders and their trading activities. It also would begin to improve the Commission's ability to analyze such information. Because today's large trader rule establishes procedures for a large trader to self-identify to the Commission, it will continue to provide important information to the Commission even after a consolidated audit trail is fully implemented. The staff is working on recommendations for Commission consideration with respect to consolidated audit trail, and I am hopeful that we will be able to move forward with a proposal on that in the very near term. I expect that a consolidated audit trail plan will build on and complement today's large trader rule and avoid unnecessary duplication or undue burden on market participants. Before I turn this over to Trading and Markets, I would like to thank a number of staff people from the Division of Trading and Markets, in particular for their work on this, specifically Robert Cook, Greg Berman, Nathaniel Stankard, Jamie Bergagliano, Dave Chilman, Richard Hawley, Christopher Chow, Gary Rubin, and Kathleen Gray. I'd also like to thank staff in the Office of the General Counsel, specifically Mark Kahn, Meredith Mitchell, David Blass, Paula Jensen, and Deborah Flynn, as well as staff in the Division of Risk, Strategy, and Financial Innovation, including Jennifer Marietta Westberg, Charles Dale, Adam Glass, and Matthew Kozora. Thanks as well to Tom Sporkin and Mark Lineberry from the Division of Enforcement, and from Corp Fin, Tom Kim, David Orlick, Michelle Anderson, and Ann Krauskopf. and John Polisi from the Office of Compliance, Inspections, and Examinations, Doug Scheit and Stephen Pax from the Division of Investment Management, and Kelly Riley from the Office of International Affairs for their important contributions and collaborative efforts. And finally, I would like to thank my colleagues on the Commission and all of our councils for their work and comments on this rule. And now I'll turn this over to Jamie Bergagliano, Deputy Director of the Division of Trading Markets, to hear more about the Division's recommendations. Jamie?